Hi guys, in this episode I will show you how to optimize a simple moving average strategy. For that I have prepared a code which I will explain you and then I will show you how to interpret the results. Currently you don't see me in the familiar surrounding. I'm in Dubai downtown now. Enjoy the view. This recording is just for entertainment purposes and this is not financial advice. What I explain you and you are doing is your own risk, but I want to show you how I would do and optimize a simple moving average strategy. Here you see the code. I load the Apple stock for the previous 5 years and then here I have a double moving average. My short line is 20 days and my longer line is 60 days. And if the 60 days moving average is above the 20-day moving average, then this is a buy signal. And if the 20-day moving average is below the 60-day moving average, then I will sell because I show a downtrend again. And if the 20-day moving average is higher than the 60-day moving average, then I hold my position. In the next step, I calculate my performance. If there's a buy signal or the previous day there was an open position and I have an open position now, then I assume that I open at the open price and divide it to the close price. And I also add a slippage, 0.15% for trading costs, and also that I can't buy it open. I have to assume that I will buy slightly above the open price. And then if I hold the position, then I calculate a normal performance with the previous day close price divided to the close price. And if I have a sell signal and the 20-day moving average is below the 60-day moving average, or in this case I had an open position the previous day but now I have a closing signal, then I assume that I sell it to the open price with the slippage again, what I showed you before for trading costs and for that I'm not able to sell it at the optimal price, divided to the previous close price. And my performance is the cumulated product of each day's performance. Then I also calculate the Sharpe ratio. That means unit of risk per performance. And for the performance, I take the daily performance divided to the daily standard, the deviation of the performance. And then I also calculate the drawdown. This means from a maximum, a loss to a local minimum. And I also check the number of trades which I use, and this is the E is my variable for my moving average, which I will explain you then. And I compare the same data with a buy and hold strategy. Then I will plot all these ratios in a single plot. I will plot the performance, the Sharpe ratio, the drawdown, and also the number of trades. So here I said a 60-day moving average, but I will change and try it from 30-day to 300 days in 5 steps. So I have 30 days, 35 days, 40 days, and so on. And for that I replace the 60 with my I. And then I calculate all ranges from 30 to 300 days, and let's see the results. Yes, I got some error messages because of the NA handling, but let's check the results. Okay, first of all, my performance. This is my performance, and here I see for 50-day performance I tripled my money. And also, if the higher I go with the longer moving average, the performance deteriorates, and also then it becomes quite better at the 200-day average. This is quite common that it runs good for 200 days, but I see that with all moving averages I would underperform this stock. That doesn't necessarily mean that's so bad. And here, for example, I see my Sharpe ratio. That's the risk per unit of performance. And I see that if I have a low moving average, I have a higher Sharpe ratio than with higher days, higher number of days. That makes sense because I stop out faster than with a longer day moving average. And that, for example, could make sense if I want to make a leverage trading. And then, if I use the leverage, then I properly can outperform the market. In our case, I didn't calculate the yield for the Sharpe ratio. I assumed that yield is 0, but you have to add your refinancing yield for the leverage, and then you can calculate your personal proper Sharpe ratio. Then here you see the drawdown, and also the drawdown is much lower than if I would hold a buy and hold portfolio. Of course, the number of trades with a lower number of days is higher than with higher number of days. Let's try something else. For example, if I set here for a 10-day moving average, I have to keep the name the same because the variables are used. So I optimize it from 10 days. I start from 15 days, 10 days, 15 days, and let's see how the results look like. Okay, if I have a quite low, I make it bigger, but if I have a quite low number of days, it looks like it, for example, for a 10-day and 15-day or 20-day moving average, then I can outperform the market, and I also do a good Sharpe ratio. And also my drawdown becomes significantly lower, but my number of trades becomes high. Now the trick here is that you have quite precisely calculate your slippage and your financing cost for the Sharpe ratio to calculate it properly. I mean, the second issue here is also that the past performance is not a perfect predictor for the future. Then I will show you what happens if I would start with a longer moving average. For example, the short is 15 days, then here I have to start with 55 days. And I wait for the results. And yeah, it seems that it's better to optimize the lower value, but I have a lower performance with a 200 days moving average but a slight better Sharpe ratio, and the drawdown is also better in this case. So you have to play around with both parameters. First your lower moving average, and then also your second, the longer moving average, to find the optimized values based on the stock and based on your performance strategy. I hope I could help you, and if you like this video, then do the like button, and if you want to become a successful trader, then learn and subscribe to my channel. Thank you.